Hey, greetings and happy Thursday. Thank you so much for joining. I am hosting this guest captain interview series so that we can all get a little smarter. And one very smart real estate expert is joining me today. I'm very excited. Again, this is macro to micro power hour. We're going to talk about real estate, inflation, interest rates. This affects our world and bond market, equity market, etc. Very excited that Logan is here to join me. Logan, I can see you, but I can't hear you. How about you? Let's unmute you and
All
get
right,
there. You
there we
are.
go.
Yay. All right. So I've got closed captioning on. We are broadcasting. We can hear each other, see each other. How about you do the intro? Because I am just going to be all like, this guy has been on Bloomberg. He's been on Real Vision. I listen to you as a place to go for sanity when everyone else is doom. The sky is falling. And I would like you to do your intro properly. Please go.
Well, name is Logan Mohtashami. I'm a lead analyst for Housing Wire. Professionally, I've been in the mortgage business since 1996. I've been a financial blogger, and I've been tracking housing data since 2010. And I think most of the people that know me know I'm a big charts guy. And recently I retired. So basically, all I do right now is just look at housing data and economic data. And that's kind of my thing. And people who followed me over the years can understand why housing has done so well during this pandemic. And hopefully, I could bring some of that knowledge to everyone here, because I think what we saw in 2020 was the biggest whiff ever recorded in history from the housing bears. And I need to explain why this happened so you have a better understanding what really drives housing economics, and then the bond market, mortgage rates. What can we expect for 2021?
I would love that, because one of the things that I wanted to just kind of quickly, if I can get this on here, the correct page, in highlighting your background, obviously, is one thing, but the fact you've been doing this for such a long time, you were featured in the a Real Vision episode, and I actually asked you back in April, when folks were absolutely worried about a mortgage meltdown. You had a perspective that was a little bit different, and we talked about it a little bit. And I definitely want to fast forward to today, your particular view here in this article. Basically, I grabbed sections of the transcript and from your interview that I thought were pertinent. But this was very, very prescient at the time, not to freak out. We'll weather the storm. And now I want you to kind of revisit, also go back to that tell, if you will, where you were not freaking out, and to so go do that introspective kind of review of that piece. And then obviously we're going to look forward a little bit. So go right
Okay,
ahead.
well, March 9th, of course, that's when we started to really feel the panic of the COVID-19 crisis. Bond yields were collapsing. I think that morning, the 10-year yield was at 0.32% trading. And the first thing that came to my mind, I think I tweeted out that, oh, we're about to get a mortgage market meltdown. And
Say
immediately
that again.
a mortgage market meltdown.
Yes. Okay.
And immediately people started to think, what's going on? Is this 2008 again? No, it's the exact opposite of 2008. Mortgage rates are going to fall too fast, and the business of doing mortgages was just going to blow up, right? And that week, if people remember, mortgage rates actually went up 1%. Because to me, when mortgage rates go down so fast, so quickly, basically people are just going to lose money left and right. Because if I pay you a certain amount to get a loan and a rate, and that person can refinance within 25, 30 days, I lose that money. So there was no way the industry could actually allow mortgage rates to be priced correctly in this crisis. And to be honest, it never was priced correctly in this crisis. We should have gotten to about 2.25% mortgage rates, but the system just wasn't ready for it. However, a lot of people made it out to be, oh, here we go again. Here, the banks are going to blow up. The leverage is here. No, it's the exact opposite. We had the best loan profile from 2010 going into this crisis. I think that's the big thing. I think a lot of people mistook is that we didn't have a consumer debt leverage bubble, right? That's what drives the economy. Home owners had fixed low debt costs. versus rising wages. They just kept on refinancing. So their balance sheets look good. On top of that, you have the nested equity. So immediately we had just chaos all around us. And one thing I wrote in April, besides what I call is the AB economic model on April 7th, talking about, what we're going to recover in 2020, just follow these data lines and dates, put specific dates, March 18th, September 1st. But for housing was just wait until July 15th.
Yep.
Wait until July 15th. And then you'll see the June data. By then, everything will be answered if we just continue the trend, because the number one thing I think about housing in 2020 wasn't the V-shaped recovery, was February. February 2020, housing data broke out for the first time since the early part of the century. Nobody cared about it, of course, because we have a global pandemic virus. But when I saw on that data lines, I was like, wow, housing really broke out. And for me, it's always been, we were going to have the weakest recovery ever from 2008 to 2019. But 2020 to 2024, historically speaking, is the most unique period ever in U.S. history for housing. We have the best demographics ever running into their first-time homebuyer age. And also we have the lowest mortgage rates ever. You put those two together, it is just a lethal combination against these mega housing bears who are talking about 30, 40, 50% price crashes in a calendar year. So we had about 9 straight weeks of negative year-over-year data on purchase applications. But after the 5th week, it stopped going down and it started working its way back up. So my work a lot of last year was to try to guide people into what was about to happen. And even when I talked about in the summer, hey, we could have positive year-over-year sales, people are like, no way. And because there's a lack of understanding how important demographics are. And not only did we have a V-shaped recovery, the United States housing market was the most outperforming economic sector in the world, because the two things that really drive it are the best ever. And whenever you think of a crisis or a recession in anything, goes back to February 3rd, what I wrote for Housing Wire. If chaos comes, rates go down, bond yields go down, stocks go down. Who does that benefit really? It benefits housing. And in big picture, if you look at it, since 1996, it's very rare for existing home sales to get under 4 million, right? If you look at it, the data mortgage rates started to come lower, demand picked up, prices also picked up. We had that deviation from norm in 1996. But not everything is going to be a bubble. Not everything is going to be an epic crash. You only need 4 million mortgage buyers each year to keep the housing market stable, because you have
That
15.
that data point, though, most people don't know, and more to the point, they saw joblessness at all-time highs. So that was a freak of nature spike in, unemployment that obviously has not recovered, but in large part the parabola, reversed. You were not worried about the joblessness. You were not worried about forbearance. You were not worried about, the REITs that had obviously tumbled, and that was a big deal. And they cried and they got support back in March. There was a Sunday powwow, right? And they were saved. That was a really, like, the 11th or 12th or whatever. So how does joblessness come into the picture for you?
And that was one of the questions a lot of maybe economists came to me. Why are you aren't worried? There's 20 to 30 million people that are unemployed. And I go, you forgot to count the 133 million people that are still working, even at the worst levels of the crisis. Now, the difference between now and let's say 2008 was the first year where we see this decline in prime age labor force, right? That's why I've always used those years, 2008 to 2014, not the best demographics, but still millions of people bought homes back then. So right now you're in a very unique period, 133 million people working, and majority of the job losses were tied to service workers that are renters. And that's another thing I talked.
Yes, the renters you had mentioned were going to be obviously pinched and hard. The forbearance programs, they released this data, and this is one thing that I pinged in Twitter on as well. What are your concerns in this regard? Because the renter forbearance can't go forever, and they still have other bills to pay. What does that really look like as far as a warning?
Here is the thing: forbearance was going to be the biggest non-event in terms of scale. I don't know when I'm talking about homeowners, right? Right now, people, they miss the crisis, right? So what do housing bears typically do? They push the bar, they push the goalpost, and now they go forbearance. Well, if forbearance wasn't here, home prices would crash. No, the demand was there, right? Within 5-6 weeks, you saw the difference in the data. Forbearance itself, and this is why I coined the term forbearance crash bros. The people that were looking at the data, if you look at the nominal level of forbearance, which I still believe half of them don't even need it, right? It's much lower than the shadow inventory was in 2012. So you have lower forbearance, you have better homeowners, you have nested equity. It's not going to be the crisis. And the biggest problem is that when jobs come back, because these homeowners, these are owners, these are not investors, they want to stay in their house. If they got their incomes back, they will come off of this. And you saw that decline from the peak of forbearance to where we are now, a little bit above 2.75 million. In time, this data is going to get better and better and better as the jobs return, right? Because every single one of these homeowners had the ability to own the debt the time they got it. These weren't 220 or, interest-only loans, option arm loans, 80/20s. There weren't any of these products here. You could have two people working full time and you wouldn't be able to afford the house. It's much different. So as time goes by, because this is a process, it's going to take some time. Forbearance, they're probably going to continue this all the way to 2021. And most people are going to be able to get off of forbearance. It's just going to lag a lot.
Plus, and what percentage, maybe not a number per se, but the trend of refinancing into these highs? I mean, you've got this perfect, backdrop, if you can refinance, that is, of low rates and no question, higher housing market, higher prices to refinance into, or potentially a boomer to sell into. And downscale. Is there any kind of like tracking on that type of data?
Well, majority of Americans already have really low interest rates.
Yes,
below 4.25. So when this crisis happened, you're talking about everyone having basically 2.75 to 3.25 mortgage rates now. And that's everyone, barring the people that really, some people just don't want to refinance, but right now, majority of the country just had another layer of fixed low debt costs versus rising wages. So the cash flows were already good. And one of the charts I like to put up always is from the New York Fed. If you look at FICO scores of homeowners now in America, it is massive, 760 and up. You go look at 620 and under, you need a microscope and you need to look in there and go,
right.
Oh, there it is.
So you see health. This, however, I have to ask, how long can this, train go? I know you've posted 20 to 2024. You're unfazed. You're worried as we approach the end of that 4-year cycle. Is that correct?
Well, this is just a very unique period where, okay, a good way to look at this is ages 27 to 33 are the biggest in America. 32.5 million Americans are in that age group. So they're running
into the number again. How many?
32.5 million.
Okay.
Right. If I could tattoo a census chart on my neck, it would show that age bracket. And we've never had a group this big running to their first step. So think of them as replacement buyers. The reason I don't like using the term housing boom or construction boom or anything like that, mature economies don't typically have a boom unless it's some new sector that's coming in and there was no production before that. But think of them as replacement buyers. If people are moving up, people are moving down. If you have cash buyers and investors, you put all of that together, you easily going to have 4 million home buyers like we've always had since 1996.
So that's the magic number. As long as it stays steady or above 4 million, okay.
You're okay. And there's no reason for that to change. In fact, I've
even if the market was to collapse like a 2000 or a 2008, equities obviously get pummeled. They're down 50%, like happened 20 years ago, like what happened, not too long ago. What would you say then?
In 2008, we had over 4.3 million total home sales. So even in the worst of the crisis, you still that. Now, what happened during the housing bubble years, and this is one of the charts, Len Keeper from Freddie Mac does a good job. Home prices caught up to per capita incomes in 2002. Then from 2002 to 2005, we had speculation credit demand. Okay, not good. That's where a bubble continues. Everybody wanted to make money on housing. The debt was bad. It's the exact opposite now. You have the.
You don't think they're taking money out to put in the stock market?
No, not like they used to.
A HELOC here, a HELOC there.
You might hear stories about that, but it's just, and even if they were able to get a HELOC or a cash out, they have to qualify for that as well. And now this is where my mortgage background kicks in. Everyone's good here, right? Let me put it this way. This is where I would be cautious. If cash buyers all of a sudden started to come in and become a bigger part of the market, there's where your speculative demand would be from. But if you look at the last existing home sales report, cash buyers down year over year, percentage not much, but down still. Sales to investors down year over year, mortgage demand up. So it's just a healthy market, and just think of it as replacement buyers, steady, sticky replacement demand for the existing home sales market. New home sales market is much different. They're about as different as you can get. But existing home market should be stable for this
Okay, so
period of
existing
time.
is stable, new home sales bullish, but not as much.
Here's the big difference. The new home sales market is very small. It just had the weakest recovery ever in history, but we're at levels now. The demand's good. Even if you look at today's new home sales report year over year, as long as mortgage rates stay low, this sector can push along. But when mortgage rates, even 5% mortgage rates back in 2018, what it do? It created a supply shock. So I kind of have a rule of thumb, and this is how I look at the new home sales market. I don't look at anything else but monthly supply. Monthly supply below 4.3 months and below means everything's excellent for the builders. The builders can build, they can do whatever they need to do. Once you get 4.4 to 6.4 months, it's a little bit tricky because you need demand to really pick up. Right now, it's all about new home sales, single family starts, right? Multifamily construction was down 39% year over year. Why? Rents, right? There's
Yeah.
supply out there. So as long as you stay below 6.5 months, because twice now since 2018, you've had these supply spikes and builders pulled back. But even then, we're so far from like the peak of where we were in 2005. But the new home sales sector is very rate sensitive. I used to say when the 10-year yield gets above 2.625 or 2.62%, you get over 4.5% mortgage rates. Watch the sector; it will get impacted. Now I'm saying, hey, listen, 1.94% on the 10-year yield, above 3.75. Keep an eye on that, because this is not like the existing home sales market. This is a sector that provides a more expensive home. They've done a better job of making it less expensive by providing smaller homes. But this sector is very rate sensitive. And of course, right now it's benefiting the most. It can peel off some buyers from the existing home sales market. And just think of the existing home sales market as this massive marketplace with all this supply all over the country. And this new home sales market is really expensive, trying to build more expensive homes and try to get as many buyers as it can. It's very rate sensitive there.
Okay, and let's talk about what happened with this migration from city to the suburbs, suburbs to the countryside during COVID, and of course the work from home impact on construction and remodeling, or making the homes more valuable by higher comfort and quality of life, if you will. I mean, bathrooms are like the highest area of remodeling. It's fascinating.
Yeah.
But my point is, that particular trend of moving out of cities and into suburbs and suburbs into country, what's that like?
I went on Real Vision second time last year and I said cities aren't dead. So I think this conversation is
Culturally,
the
yeah.
most, this is the most interesting one. Take COVID out of the equation. This was happening always. It just never got any attention. I've always made this claim that years 2020 to 2024 is unique because people, and I say this at every conference, people rent, they date, they mate, they get married. 3.5 years after marriage, they have kids. If you live in an expensive city, you move to the suburbs. I've been saying this for like 7 or 8 years, years 2020 to 2024, you'll see better migration data. Then COVID happened, and all of a sudden,
An accelerant. Yeah.
Here it is. I don't think what we saw last year was about COVID pushing people out. I just think that was the natural progress. But the one new variable now, which is the most exciting thing for housing that I'm probably ever going to have, if it is true that you can work from home and people can move. Now, there's a certain group of people
they want.
Anywhere they want. If this is true, because I'm not sold on this idea yet.
Really?
Then I'm not sold on it because right now,
you don't have enough data points.
Well, how many people beyond the normal trend, right, can actually move? I mean, tech companies don't employ really that many people. So it has to be maybe engineers, stuff like that. Maybe somebody that could work from. I don't know how many people will actually move.
How about
from the
from
city.
rent? Well, how about prices of rents and such in San Francisco, New York City that have dropped because of this relocation trend?
Well, it has, but if you look at Manhattan or New York, some of it has already rebounded to a degree. So at some point, the cities have just a unique perspective in terms of how people look at it. People just love the cities just for the lifestyle.
Hmm.
I hope it's true, because this is a big thing of my work, is that people are going to move to the suburbs during this year. If it is true, we could get an acceleration. What that is good for is inventory, because this is a thing that can actually, well, people have been staying in their homes for 10 years now. One of the things I was actually afraid the most, and I've written about this a lot, years 2020 to 2024 has the potential for real home price growth to take off. What's happening now, real home price growth is taking off. Why? Demographics, mortgage rates, but people are staying in their homes longer, right? From
Yes.
1985 to 2007, it was 5 years. Now it's
Don't have
10
the
years.
job mobility requirements.
It isn't, but a lot of people just like the cities, but at a certain age, I use San Francisco as a test case, right? Condo supply was picking up, right? And that makes sense. If you own a $1.5 million condo, 800 square foot in San Francisco, and your boss told you, hey, if you wanted to move 30 miles east and work from there, go ahead. We don't need you here. Move. God, everybody, especially if you have kids, right? If you're having
Hmm.
kids, you can't live in a condo as much. So this is the time where, if this is true, and I really hope it is, people can move to cheaper areas. That gives home sales. Also, it provides an inventory, right? You have to put that home on the market to sell. This is a new variable. This is not like, we had this before. So I'm excited to see if this works. I just need about 1 or 2 years data to confirm that this is actually a legit thing that can actually move, because I think it'd be such a positive for the US housing market.
Where would you
If
see
people
the biggest pockets of growth?
anywhere in the Midwest and the South. I
Because
mean,
it's
I mean,
away
Texas,
from the away from the the coast. You're
yeah,
scared of
away from, I
affordability.
mean, away from Seattle, California, New York. Because think about it, families, right? If you have a family of four, and you can buy a house, like you can buy a condo here in Irvine, you could buy a mansion in Atlanta, right? So
Yeah,
it's
yeah.
just that they're just people that need bigger homes because they're finally having kids, or they have a second kid, and if they're allowed to move, they're going to move. So I think, be excited about it, but wait for the data to confirm it, because I was expecting this anyway. But with this new variable of work from home, it's really exciting. But again, we're still too early right now to make kind of a big deal about it. But again, everything is kind of converging together for housing during this period of time. So it's a very exciting time for me.
Oh, well, I live in an area which is Boston, Northeast, and there's no lack. There's actually a lack of inventory, so there's no lack of
Mhm.
housing price appreciation for that reason. So the industry is quite busy in the construction world, and in house prices. But I know in other places it's obviously a little bit different. Are there any areas that you think will suffer the most? This is
In theory, it would have to be, San Francisco is a test case that I would use that. I think sometimes we get obsessed with San Francisco. Like, we look at San Francisco as like that's supposed to be the national housing market. No, it's just like a complete one-off planet compared to everything
But that's
else.
what makes it
Uh,
fun to actually study as a case study.
it,
How did
it
it
makes it
become an
fun,
outlier? Yeah.
but it's holding up well. It's not like San Francisco sales are down or anything like that. People said, well, California sales are going to, with the salt deductions. When people said,
Hmm.
oh no, California just had like 28% year-over-year growth in sales. Okay, so the demand is there, the demographics are there. It's just there's going to be certain cities you could keep an eye on, but right now I just don't think there's enough data to show this is a big thing yet. And
Okay.
then let's see when 2021 happens, when the virus is gone and more people can walk to Earth, what happens? Because I think a lot of people who are even renters will move to areas. I mean, even Las Vegas compared to Southern Cal, Las Vegas is cheap. Nevada is very cheap to Southern California. Boise, Idaho, which is getting tons of people from Orange County, California here, is so much cheaper than here. So I think there's places where you can see the data. And Boise, Idaho is a good example in terms of really benefiting. They're building a lot of new homes, and their new homes are really cheap to an Orange County homeowner. So I think there are some pockets where you see population growth picking up and you see buyers coming in, because think about the buying power they would have. Big down payments, some could even pay cash. Those are the places. Let's wait until the end of 2021 and see what really happens. But it is a very
Okay.
exciting new
How
thing.
about the investment opportunities? I mean, we're talking about the collective housing data for, given low interest rates and demographics. And then, like you said, the millennials who will start, nesting and having babies. And it is a big crop, right? I mean, that's coming through. How about for those with lots of cash in their pocket? They're looking for opportunities. They're actually fighting over opportunities, at least from in my backyard that I can see. They're looking to move from paper to things. So they've, gotten a lot out of the asset appreciation in the market, for example. They're taking chips off the table, and they're definitely investing in real estate, not just second vacation homes, but big honking projects. So what about investment opportunities?
I mean, to me, if you're looking at an investment idea, suburban homes that can take care of a family of four and more, right? That is where these people are moving to. If you can buy
Okay.
it and then, remodel it and make it suitable for a family, that is where the action. I don't think you're going to see a lot of real estate investors. They live off foreclosures and distressed prices. And
Yeah,
I just
there
don't think that's, yeah. I
aren't that
just don't
many
think that's
available. That's what I'm hearing.
there.
They've
Yeah,
been scooped up.
it's just not. Yeah, it's just not. And it's just, I cannot imagine the Biden administration or even the Trump administration, if he was still president, basically saying forbearance is gone, you're on your own, right? Until we get all those jobs back, until we get back to February 2020 economic data, where we still have about almost 10 million jobs left. Until that happens, I just don't think that's going to be. There's always opportunity in distress and markets. You got to be really picky. There's just not a lot out there. So I'm not sure that's going to be the big thing. I think a lot of even the foreclosures now are backlogs from the previous, before COVID. So suburban movement, people want homes, people want bigger homes to a certain age demographic. If you get it, make it suitable for them, they'll come, right?
Definite investment. And what about these baby boomers? I mean, the ones that have that again, the threat is they're going to sell en masse all at the same time, draw from their pensions all at the same time, crash the market, both housing, equity, bond, everything's going under at the same time. What do you say to that?
The silver tsunami is one of the greatest marketing gimmick shams I've ever heard in my life. Because you know what? It is. I tell you, man. First of all, the first boomer hit 62 in 2008. So the silver tsunami, in theory, housing bubble boys are really predictable, but it was supposed to already happen, right? We've gone through 13 years. This was supposed to happen, 5-6 years ago. It never did, right? The stock market, everybody drawing out all their, the notion that
Because
all
rates
baby
have
boomers,
gone down.
I know, but the notion that
Inflation has gone down. I mean,
yeah,
we got to get to
yeah,
those two very hot topics, but yes,
yeah,
continue.
but the notion that baby boomers all are a collective whole that will all sell in mass together is crazy. It's a great marketing gimmick, silver tsunami. You can trick people out of there. I mean, I've ripped this thesis for many years. It's just the velocity of inventory is not that. I wrote an article on April 10th. What will it take to crash home prices? Very condescending article, and it's just the velocity of inventory is just not the same.
Talk
So
about that a little bit more. Dig into that so I understand velocity of inventory. I know velocity of money. I know rate of change and all kinds of instruments, but I want to know what you mean specifically.
So if you look at post 1996, right, when mortgage rates started to go lower, the only time we've had 6 months supply plus really is from 2006 to 2011. That was an overinvestment. I know some people disagree, but we overbuilt homes. The demand was too high. And then we had an 82% crash in new home sales. And then we had all this bad debt. 2006 to 2011.
Okay.
If you look at supply, those were the only period in time where it was the housing bust years, right? And then in 2012, monthly supply came low, and we have never been able to crack that. Why? Because rates are too low, demand is too good, right? And you just needed you need some type of event where you have a job loss recession at higher rates, and for it to stick, for
So
inventory.
isn't that interesting timing with the 2011-12 QE, and that has just continued and just continued. Again, volatility suppression, interest rate suppression, interesting timing, kind of saving. Yes, so this peak to trough, 82% change. It bottomed, you say, in 2011.
Well,
And it's
new
almost
home
a
sales,
double
yes.
bottom, new home sales, and it's the
New home
double
sales,
bottom, if
yeah.
you will,
Yeah.
in housing, that I remember seeing, like the little W, if you will. Okay,
Yeah.
2012, we're off and running.
We're off and running. And then if you just look at the 19, like I always look at housing now from post 1996, and just realize that you just have a lot of people that need shelter. If you think of this, housing is the cost of shelter to your own capacity to own the debt, not an investment. That's what the majority of home buyers are. They're buying somewhere to live in.
Mhm.
They don't do this. It's not like a stock market to them.
No,
They make money. I need a home to buy.
okay.
If I think some people look at housing like you would look at a stock, like we're always on some razor's edge and we're about to collapse. Just look at existing home sale data from 1996. You can see how rare it is to get sales under 4 million. It happened at the tail end of the housing bust. The 1 month, like a few months after the home buyer tax credit, which was actually just that was a one-off event. 1 month of COVID-19 sales. That was it.
That was
That's
it.
what
Okay.
COVID did.
And I remember you talked about that. We need to put an asterisk next to that 1 month data point.
Yeah.
And just thinking of the few boomers that I know, they don't even want to leave their house. They've been in there so
Yeah.
long.
Yeah. No, I mean that's the thing. It's just that you know, even real estate investors didn't put their supply on the market in 2020. So if you think boomers are going to be all in mass, all these real estate investors, Airbnb, nothing happened, because these are not stock traders. These are people who have a home, who have
Well,
an investment. It
real
doesn't
estate is a
move
much
like it does
bigger
a stock.
market than the bond market, and bonds
Yeah.
are bigger than the equities market. But nonetheless, we did have one cause, trickle down and wreak havoc on the other from the housing bubble, obviously. And
Yeah.
this recovery that you're saying is already been foretold, if you will, from the data points leading into 2020 before COVID hit. That's an anomaly. We're going to put that aside. Now we have the added benefit of the millennial push and the low interest rates and the forbearance. So it's a win all the way around.
It's a
Except
win.
for renters.
Well, renters, remember, one of the things that we did good is that we supplied the economy with cash right away. If you look at disposable incomes, it's higher now than it was pre-COVID. If you look at savings rate, it's higher. So we did much better this time around for people than we did in the 2008. So I think that's a big story. It still doesn't get enough attention because we always complain they don't send enough money. But if you look at disposable incomes, if you look at savings rate, they're much higher now because we injected money. Real incomes itself has basically come back to BC eras before COVID. So there are some really good things. But I think we got to remember that consumer balance sheets were good going into this. Demographics were good going into this. No COVID, no recession. You could go back and look at February data. Regional manufacturers are up, retail sales were up, and then housing kicked in. So it's a much different situation. Stress went down. St. Louis financial stress has started to go down in March and April. So everything kind of calmed itself down, and we're just working our way back, because as long as COVID is here, we can never have a normal functioning economy, right? It's just impossible. There are sectors of this economy that are just cannot run anywhere near full capacity. So we still have to work through all this in 2021. So 2022 would probably be the first year where it's somewhat stable going in. So it's just,
Okay.
we have to.
No, the stability though also, because we need to go and talk about the Biden policies, and obviously policies impact the economy. Wage inflation, $15 an hour across the board, minimum wage. How does that work into your process?
Less than, I think 2.8% of the country actually get paid the federal minimum wage. I mean, it's not this high velocity event. I think for me, myself, it'd be really interesting to see how low cost states in small towns deal with it. But until it gets signed, I actually I don't believe it.
You don't believe it? Okay, well,
I don't know. Even if they did do it, they might quietly bring it along. It might be like a 1 or 2 year process. I think just doing it like this for certain state, yeah,
overriding the states. You don't think it's going to
yeah.
happen? You don't,
Well,
not this year.
I don't know if they have enough votes in the Senate
Okay.
unless they want, if they want to start a political war on that.
Let's assume, just for devil's advocate purposes, that they do push it through federally and it gets done this year. What's the impact
I
on
think
your housing thesis?
well, nothing in a sense. I think core inflation has the ability to move up a little bit because so much of core inflation is housing, shelter costs, rents, and so it's kind of a wash, but it will drive core inflation up a little bit just because 42.2% of CPI is shelter inflation. That's rent. In time, you'll see that. Everything else is kind of a one-off. You give people money one time, they spend it, it's over. If you gave people $2,000 a month, you'll see some inflation. But again, the wage and the cost offset each other. So it's not, we don't have the ability to have breakaway inflation. We're an older, mature economy. Demographics are deflationary. Technology is deflationary. So this notion that inflation is going to come off would have to really be a currency-induced inflation. It's not going to happen in the U.S.
So this
it's
actually,
just,
I might disagree with you on that. I do believe it can be currency induced, but we're not there. So what would be your macro trigger for an inflation impulse that starts to get you worried? Because obviously this carries over to the whole not inflation impulse, but also the yield surge, pop,
well,
whatever.
here's the thing. For me, I structurally have a hard time getting the 10-year yield above 3.47%. Every year since 2015 when I started in
Yeah, we
corporate,
couldn't get it above 3.2. That was October 2018.
yeah,
So
3.24% on November 8th, 2018. That was the high recently. You know, inflation and growth, we're just an old country. We might have super growth for a very short time, and then we just go back to what all mature old economies do. They don't really grow fast. They can't really produce inflation unless you really start to do fiscal spending every month, every year, consistently. I just don't think that's going to be the case. I think there's a difference between filling the gaps during COVID, and then once COVID is done, I think you're going to have a big fight in Congress over what can be done, what can't be done. That's why I don't buy it. I just don't see how the congressional setup is going to allow $2, 3, 4, $5 trillion fiscal stimulus every single year for decades to come. The Republicans would lose too much power giving into that. So I think in the short run, you could have, and one of the things I've talked about a lot on Twitter is that you're going to see inflation data look really crazy, right? After every crisis, if you take the bottom end prices of things, you're going to see escalating prices. You're going to see people on Twitter post that this is up 12%, this is up 13%. Over time, just like in 2008, right? If you look at 2008 pricing on certain goods, then you see what happened in 2012. You saw 300, 200, 100%. But in the end, it'll moderate itself out. It's very rare to see inflation really take off.
That interim inflation spike that I remember you posted, and I reposted it because it was several 100% across each agricultural input, et cetera, et cetera, et cetera. So when it happens, it's oil, for example, it's dramatic.
Oil is dramatic. In fact, oil was a really big investment theme of mine last year. It was the most hated sector in the world. But if you believe that the economy is going to go back to normal, oil prices are going to rise, just like we saw before. In 2008, if you look at headline inflation versus core, headline really got wild there.
Yeah,
right?
the 5-year forward inflation expectations are way elevated, divergent from action. This
and that's what happens on a crisis, right? You see this crisis, you see a deflationary crisis event, and then if you just go back to normal, it's just going to look like inflation is taking off. And I think that'll be the case again, and then it just moderates itself out. But oil prices, commodity prices, you should see that. Copper, oil, all these things should be rising. It's bullish. We should welcome this. We want to see this kind of
not too much, not too fast, just a little bit, please.
It's just I just can't see a sustained inflationary theory that keeps on rising year after year after year after year, especially in America. But yeah, we're going to see some really funky data. We already see some funky data out there, and just look at
Like
headline
what?
inflation. Yeah, I mean, oil prices are going to look really high just because, on the percentage basis, you're going to see this. Corn, you see timber, you see these really big increases on a percentage. It looks like there's rampant inflation. I think over time
But
they come
but
back
on
down.
the lumber part, I mean, I studied this last summer and made some recommendations and timed some really nice lumber shorts and
Mhm.
longs and such. And so this is a triple whammy. I mean, they had that beetle infestation. They had to,
Yeah, yeah,
harvest 40% of
yeah,
their acreage in British
yeah,
Columbia. I mean, it was the perfect storm of supply inelasticity. It's not,
yeah.
it's a tree. It takes a long time to regrow. So it's not just the inflation expectation, it's actual inventory
Yeah.
destruction.
And so far, humanity has been able to fix production enough to prevent shortages over a long period. And I think that's the thing that, everybody thinks, well, these things are going to go off and take off and stay. We find a way to produce. Now, with no more trade war tweets or stuff like that, maybe things calm down a little bit. We get the production around the world, but we're going to see some data that looks very hot. I just think in time they'll come back down to trend, and then we'll be okay. Just like what we saw in 2008 to 2012. You should look at core inflation. Didn't really move too much. Headline inflation eventually came down. There's a reason why they keep headline inflation and core inflation, because food and energy prices can be wild. So know that headline can break up fast, but it should calm down.
So what
We're
would be
not
the triggers for this yield pop that you would then change your tune on both inflation and rates?
well. I can only go to 1.94% this year, and there's a lot of things for the economy has to go well, and that's kind of it just for 2020 21. I still can't get the 10-year yield above 3.47% unless I can see fiscal stimulus being done every single year for a long time. We should be low bond yields like every other mature economy for a very long time. It's just we're just not a fast growing labor force growth, population growth are slowing down. Japan's going to lose 40% of their population by the end of this century. These are not inflationary items, these are deflationary things. So we'll
We've
see
even
some
talked about technology as a massive deflationary force.
yeah, and I think 10 years from now, when they actually really do incorporate internet pricing into the PCE data, that it's going to show that,
That's gonna go wild.
yeah, it's just not prices of certain goods. Amazon, it's just not. We just can't create that kind of a consistent higher inflation. We're just not that kind of economy around the world.
All right, so
And
the inflation risk not on high on your radar, higher yields not high on your radar. What about negative yields?
well, before the 10-year yield broke lower last year, I said I'm looking at
For a
negative
little
20.
little blip,
Yeah,
just
I
a
said
blip.
negative 21 basis points is the first time I even said that. Negative 21 basis points is 62 basis points. That would be my recession, just because this was such a
Say the,
deflationary.
say the levels
This was a
again.
negative 21 basis points to 62 basis points. That's what before COVID really hit, before the 10-year yield drop, I say that's my recessionary yields for this. The fact that we were above 62 basis points for a lot of the periods last year, that was my cue that it's weird to think that way, but that was my cue that the economy is going to be okay in the upcoming quarters. When we're below
No,
62
it's
basis.
actually it's a really solid assessment. I mean, negative is NERP is negative, period.
Yeah. So we got to 32 basis points, but the government came in and prevented a deflationary
Yeah,
downturn. So they did their job.
yeah.
So I think maybe over time, definitely a negative 10-year yield is in play. It's just right now we're okay. We should be between 62 basis points and 1.94%. That's where I'm looking for 2021. Over time, like if we can't get to 1.33% on the 10-year yield this year, something terribly wrong would happen.
What do
And
you
it's
mean?
not that we're not, I just think an economy that's functioning in the US, the 10-year yield should get to 1.33%. That means the vaccine works, more people are walking the earth freely, people start doing things that they normally do. We should get the 10-year yield just about there. And that was the whole basis of the AB economic model I wrote on April 7th. There's going to be a time where we want the 10-year yield below between 1.33 to 1.60%. That means the economy is back to normal. We're not normal now. We still have sectors that cannot function properly. Once that is gone, the bond market will get ahead of it. And that's why I've said the 10-year yield should get to 1% before the year's over in 2020. I think we have the 99 basis points. It's working its way back, right? And this is such a horrific situation in terms of what it's done to certain sectors. But in time, when more people can walk the earth, the economy should go back to normal. And there it is. There's that little range, and that's the range I'm waiting to see. Can we get a range between 1.33 and 1.60 on the 10-year yield? And if that's the case, then most likely the vaccine's working, and all this excess savings and income and everything, and people get to spend more on more things, and more people work and wages come in. That's what I'm hoping for 2021 at some point. But if we don't get there, something probably went wrong with the vaccine.
Okay, so then let's, take a look at the equities market, because housing is, stable. We've talked about the risk of inflation, deflation getting too out of control, which is very low. This equities front running the vaccine rainbow. You can see it. It's extreme valuations across the board. This rotation, whether it's the SPAC du jour of the day, the EV euphoria. I mean, I could go on. The point is, this is a very elevated and dangerous market, in my opinion, from an equity standpoint. So real estate saving grace, treasuries are not going anywhere, right? They got their backstop by the Fed.
Yeah.
But equities a little bit more slippery. So what's your view, since I know you're big picture and I'm talking longer term view, but when you are looking at the market every day, what are you looking for risk and opportunities?
Well, for sure, we haven't had a pullback. I mean, a legitimate 10% correction in a while since
Not
March.
allowed.
So the longer this,
way.
our drawdowns would have been like 7 or 8%. They've been bought every single time. So at some point, you're going to see this. It's just, like in May, I did a tweet calling, "Hey, this is the Roaring 20s backdrop." People go, "What do you mean?" It's like Spanish flu 1918, but remember, excess savings. We have a lot of excess savings. We're also about to inject more cash into the system. We have good demographic, rates are low, inflation's low. We're looking at, for the first time, real fiscal stimulus with the Federal Reserve together in a low inflationary environment. That's a good setup for the economy. The question is, can you really have an aggressive pullback or aggressive downturn if the economy is in expansionary mode? You can have corrections. We've had near 20% corrections in the previous expansion, but can you really have a sustained move downward with the economy in the expansionary mode? I don't think so. I think you could have pullbacks, you could have near bear markets, but they will be bought up just because the economy is still expanding. Who knows when the next time the Fed raises rates, right? Because they're in their minds, they think, boy, we need to see wage inflation. We need to see very low unemployment. We need to have the lower income Americans. Tighter labor markets are a good thing. Janet Yellen, everyone's not going to make the same mistake they did in 2015, right? They're going to have to see unemployment rates really low. They're going to have to really see wage before they even start hiking rates. So that's a backdrop for expansionary data. So you're going to have pullbacks. The longer we go without a 10% correction, the more. Remember 2017, the VIX was in single digits, it was dead, nothing was happening. You eventually got a pullback, it will happen, but most likely they'll be bought because we're so far from a tight labor market, from wages really pressuring anything, that this thing has legs.
So what about the populist movement? Let's talk about, this sentiment, if you will, that the new administration, either by design or default, because of sentiment, if you will, moving toward people over profits. Clearly, that was a little bit different mood, if you will, of the past few years, where we had corporate tax cuts, we had just a very different backdrop. So what is your feeling if there is going to be a little bit more movement? Instead of profits over people, it's going to be more people over profits. Let's give it to Wall Street. It's, I know, talk right now, but what's the likelihood, in your opinion, that they're really going to make any substantive changes in or around Wall Street, let alone corporate America, to really impact equities?
Joe Manchin from West Virginia is going to keep everything at bay. He's literally one of the most powerful people in the world now. I don't think anything is going to get too extreme because Democrats don't have 60 votes in the Senate. Everything revolves around the power in the Senate, right? So it doesn't matter who you have in the White House. The Senate really makes a lot of the big financial decisions. So I don't see it. I know there's going to be tons of noise and everything, but what's been the trend for a long time? Taxes go lower. Corporate taxes are low. We haven't seen, even with all the drama after 2008, we really haven't seen any change in the, you know why? Because people like low taxes. Whenever you bring higher taxes into the equation, there's a big fight about it. So I just don't buy it. If you told me the Democrats had 61 votes without Joe Manchin, then okay, I'll legitimately think it. I just think, like always, politics is the word itself. Politics. A lot of noise, a lot of ticks. To get real substantive change, man, you really need the Senate. Even though the Democrats have the Senate, they just don't. I don't think they have enough votes to really make too much of a difference.
Okay, and we actually talked about that, clients and I, because there is this forgetfulness that the 60 kind of matters. And also the first 100 days, how much can really get done? Political will is pretty much expended at the end of that period. So, choose.
I mean, you might go from a $1.9 trillion package to 1.2 or 1.1 or something like that, and then there's only so much, because you have two parties. There's only so much that can be done, right? And you have to use your kind of your 100 days for what you really believe. And in this crisis, that fiscal disaster relief is more important really than anything else, because we still have this virus. There are sectors of the economy that cannot function normally. Doesn't matter how much money you throw at people, they're just dead in the water until people can walk the earth freely. Because behavior, right? Behavior is what changed early in the crisis, right? We all froze. Everyone froze. Everybody thought, people were hoarding toilet paper like crazy, but the second and third wave of the infection, we learned to consume goods and services with an active virus infecting and killing people. As crazy as that sounds, that's what the data has shown. So I just think that getting that disaster relief to the people that actually need it is more important than maybe some of these big ideological battles, and that'll keep everything kind of at bay.
All right. When you say everything at bay, meaning no movement, the market loves no movement.
I mean, yeah. Listen, it's just a matter of time. Just everybody go look at the drawdowns from 2008. Eventually, there will be a correction. The longer it goes,
there will. And the danger is that the muscle memory is very quick to act now. And meaning we had this dramatic drawdown in February, March. It was 35 days. About the equivalent in a pullback, right? It was like 35% in 35 days. Wow, it was really quick.
Yeah.
Now, granted, we had massive intervention that followed, and $9 trillion in central bank, infusion of liquidity later. We're not just above; we're way above in certain sectors. So, in 2021, the question I am constantly looking at is, okay, so equities right now don't have an outperformance look in my mind for this year. Commodities are still coming up off the bottom. So commodities over stocks or stocks over commodities by end of year, if you were to make a prediction.
I would go with commodities.
Yeah.
They have the bigger upside.
Yeah.
I love
it.
There's a lot of big numbers.
It is. And also, here's another question, because it's along the same line. For hedges, what would you, and I know you trade, so would you go with the new gold, Bitcoin, or the old gold, Bitcoin? Would you use dollar? What would be your, the rotation into safe haven, if you will? What do you think will outperform? I'm just looking for that one outperformance in times of turbulence in 2021.
I think if you're going to trade around, if you're going to have your hedge trade, it's for me, I've got oil and steel. And then I've got some of the high flyers, right? So US Steel, HP, the driller, those things, if you get a reflation trade, you get construction, these things should go up. And then you've also got your hot money plays, right? And they should work off each other.
What do you mean hot money plays? Like, what do you consider?
Just the AMCs, the GameStops.
Those short squeezes. Yeah.
yeah, but even beyond me, stuff like that. There's always there's gonna be stocks that just have a lot of money in it.
No, I'm
And
talking
if you
about
can,
hedging.
heck
What?
yeah, for me, it's US Steel and HB, right? The driller, oil and steel, because that'll
You
be the
hedge.
reflection.
You hedge with that versus go to the dollar
Yes,
or
I I
silver
I
or
I
gold,
never
Bitcoin.
I never trade Bitcoin, gold,
Okay, that's
silver,
what I'm
never.
asking. That's what,
Yeah,
okay.
yeah,
So for
yeah. So
outperformance, you're going with
uh,
commodities. It's
yeah.
basically your
Well,
deal.
anything's play because if it is true, if we do come back, right, some of these stocks are still beaten. So that should work unless the vaccine goes bad, right?
Okay, well,
That should work.
there are questions on that for sure, and variations, and the vaccine's ability to tackle the variations of the COVID. So we definitely have a vaccine rainbow priced in to equities, but I'm curious which areas of outperformance, because I agree with you on the commodities for sure, but not necessarily as the reflation trade with yields, just because they look to me to be outperforming this
Yeah.
the tech, which should, potentially
There's
go down.
there's there's limits to where the 10-year yield can do. So in bond yield, if you're looking at bond yield, just remember we still have a deflationary event in terms of COVID. So there's limits. So it's just like, how from March all the way to now, boy, that was a very, very unbelievable best buying opportunity, most oversold condition in a short time ever in history. And so we're
And
not
negative
there
oil.
yet. Yeah,
So,
negative. Yeah,
all right. So
you had a lot of dislocations in the market, so that
we
was one of
still
them. Yeah.
do, but they're not necessarily in those. So the dislocations are coming elsewhere. So your energy over EV kind of thing. How about your oil? Do you have an oil prediction in price for this year? Because it's obviously tied to the health of the economy and
I was always looking for $63 in oil
okay.
at some point. Yeah, so that's kind of where I
Yep.
kind of hit it, and some of these drillers were just priced to. It was it. Think about last year. I've never seen a sector that was so hated than oil. I mean, it was just like not only just COVID, but green energy, whatever it was. It was just like it was the end. It was coming, and then everyone's worried about do the Saudi Arabia and Russia work again and bring oil prices down. So that was the most hated sector ever. So you see this big rally. Always that first rally is going to be the big percentage move, and that's what oil did.
Yeah, and it's still grinding higher. So as far as out the housing US, are there any other international markets that you are seeing, or do you study that at all?
No, in terms of foreign buyers coming here,
That.
it's never been that big of the market. I know a lot of people make a big deal about it, but it's always been less than 3%. So of
Okay.
course, China has reduced their exposure into real estate, and depending on where the currency is going, it's not that important to the U.S. housing market in general. But certain cities maybe, but it's not that big.
Okay, so that was definitely a question of foreign ownership. Do you see this increasing trend, or is it just kind of stalled? It's just not a big.
It's been stalled for 10 years, really. There's just only a certain amount of people between the Russians, the Brazilians, Canadians, Chinese, there's only a certain amount that they usually buy. China, of course, after the capital controls started to become less, but it's not that big of the marketplace. It's kind of like the tight credit thing. A lot of people still think lending in America is tight because there's some charts that show that no, lending was never tight in America. Freddie and Fannie being in conservatorship was like the blessing in disguise.
Would that worry you?
If they were publicly traded companies with no government support going into this crisis, I would have a much different conversation
Okay.
back then. But they weren't. They were in, and that boy whistle. We got lucky there. And quietly, that whole getting them out of conservatorship is probably going to go away. It worked really benefit. Credit actually flowed to the loans that Americans were using to buy homes, right? There was a few products, I estimate about 4.5 to 6.2% of loans that were done before March 9th were having a harder time doing, but that's not big enough to really change what people were going. And most people are the same, 30-year fixed loans. That are conforming limits. That's Freddie and Fannie. That's the bread and butter, and they were there. They supplied and gave forbearance, and everything worked out.
Okay.
Considering how horrific it was, everything worked out as good as you possibly can, considering how terrible COVID-19 was.
Oh, that's a great place to end. I like that. Look back, we definitely dodged a bullet, and look forward is healthy in your opinion for the next few years. We've got some stabilization in 21 to do, but otherwise, this has been fabulous to catch up since I saw your recording there back in April and posted for clients. And I'm like, calm down, it's fine. Logan says it's going to be fine.
Yeah, yeah.
So thank you so much. I really appreciate
My
the time.
pleasure.
You have a great evening.
You too. Take care.
Bye. Thank you. And again,
Bye.
thank you for attending, everyone. I appreciate this. I'll upload it later tonight. And I wish you all a great rest of the trading week. Bye bye.